Hi guys, this is Steve speaking. Today we have a podcast for you with Steve Ellul. I first met him when he was my lecturer back in university. That's when I started getting very much into investments, and he was one of my first exposures to the investment world. Today what we're going to be talking about is a bit of where the markets are at this point in time and where Steve thinks markets could be going and what would be good ideas to keep in mind when approaching your own investments. Steve, can I ask for a bit of an introduction to who you are and where you come from?
Hi, Steve. Thank you for having me, and big well done for this initiative, which is very, very important because it really instills investor education at the core of the investor community here in Malta and beyond, of course. I've been into investments for the last decade and a half, I guess. I led the investment management team at BOV Asset Management up to recently, and now I am a university lecturer and also a financial analyst, particularly, and I'm focusing a lot at this moment in time on ESG and sustainability investing. As you mentioned, I also lecture at the University of Malta within the Faculty of Accountancy and Management.
And how did your career start in investing? What made you attracted to the world of investing? And could you give us an idea of what your first investment was?
Well, I think I was intrigued by this investment world after I read an article in the local newspaper by a local professional, financial analyst here in Malta, Alfred Mifsud, who back then I think he was the chairman of Malta, one of Malta's leading banks. And he was explaining in his very, very eloquent manner the difference between fundamentals and momentum trading on the local stock exchange. And that is something which I still remember this article, and I still disseminate this article with many of my students because it's something which really intrigued me and also helped me in my first steps in investing. And I cannot say I actually understood it all at the first reading. In fact, I still remember that my first stock, I think, was HSBC Malta stock. I actually bought shares in HSBC Malta back when I was still at university, so that is 2007. And if I'm not mistaken, I actually bought those shares at the highest ever price HSBC ever traded on. So I think, let's say I learned through my mistakes.
Not a good start, but at least you kept at it, and now you've made it very far from there.
And I still have them, actually. I still own them because they remind me of the homework you need to do before you're actually committing money.
Yeah. You're still hoping they recover one day, so.
Not really, no.
In the current market, so I mean, over time, I imagine your knowledge has greatly evolved over time. From what you're seeing today, are there any sectors that you think have a lot to gain or a lot to lose right now?
Look, Steve, in my opinion, I stay away from indicating a specific sector, and I'll tell you why. Sectors nowadays are very much heterogeneous. Within the specific sectors, you might have a lot of different companies within the same sectors doing very different things. So rather than focusing on sectors, my suggestion would always be focus on specific themes, on what's driving the market at any given point in time, and whether you'd like to invest in that particular theme or shy away from it, because perhaps you might think that there are more risks than positive drivers to that particular theme. And one particular theme that comes to mind at this moment in time, in my opinion, is the European small cap theme, which is pretty much supported, in my view, by unprecedented monetary and fiscal support, which we're seeing all over Europe, but all over the world, really and truly, because of the COVID pandemic. And that is having a very positive impact on the smaller and medium-sized companies within Europe, which tend to be less liquid and perhaps more risky as well, but potentially more profitable as well. And if you look at balance sheets of these companies, you might notice that they are less leveraged. Ironically, at this moment in time, they are less leveraged than their large cap peers. And even if you look at the amount of operating income that they are generating and that they are forecasting in the coming years compared to their net debt, they look less leveraged and more in a better place compared to the European large cap side of the market. So this is an area which I really like. Another theme which I feel is very important at this moment in time is the theme relating to carbon pricing.
Yeah.
This is an area which is, in my opinion, not adequately explored by financial markets at this moment. And basically what I'm speaking about here is not exactly shares of green companies, but what I really like at this moment in time is the fact that an investor can invest in the actual allowance certificate that companies need, large companies need in Europe to actually make up for their emissions. So the European Commission actually issues these certificates, these allowance certificates, which are an investment vehicle in their own right. These certificates are used mainly by large companies, such as energy companies, steel makers in Europe, in order to make up for their emissions via their operations. And the price of these certificates can actually be traded. These certificates can actually be traded via an exchange-traded fund. And we've seen very recently that with the European Union stepping up the game in terms of the regulatory commitment, in terms of sustainability development goals, the price of these certificates is going up. And we've seen last year, if I'm not mistaken, the price of these certificates went up, skyrocketed by 160%. This year, basically, we're looking at a situation where the price year to date of these certificates has been up 4 times the price of the S&P 500. So this is something which I really like because it's also not that much correlated to financial markets.
Makes sense. And these are accessible to retail investors then? They can just buy the ETF and they'll get exposure to that?
Yes, because the beauty of financial markets, the way financial markets have developed in recent years, in the last decade or so, is that many themes are now very much accessible, Steve, to retail clients, to retail investors, specifically via the use of these ETFs, which are exchange-traded funds, which an investor can invest in directly via a normal platform, so to say, and you can have direct access to specific areas, specific segments, specific themes in financial markets. So that's the beauty of it.
Perfect. And do you think there are any such themes or trends that might be overhyped at the moment, or ones that are maybe not getting enough attention?
I'm a little bit worried about cryptocurrency, quite frankly. I don't fall within that category of people who really don't want to touch cryptocurrency, but I'm not a blindfolded fan either. I feel there's a lot of speculation going on in that market. I like the underlying technology of some coins. Particularly, I like the underlying technology for Ethereum, which is pretty much a system which was created to ensure viability or improve the viability of financial transactions. But then you look at other alternative coins, and you see prices which go ballistic based on pure speculation, in my opinion. So this is an area which I really feel is overhyped.
Yeah.
Another area, on the contrary, again, it's not an investment area in itself, it's an investment methodology, if you wish, which I feel is undervalued a lot, is drip investing. Many retail investors think that they can only invest in financial markets if they have a big amount of money available. In reality, you can invest in financial markets even with small amounts on a regular basis. And when I say small amounts, I'm speaking about 100 euros, 200 euros a month. And doing so literally drip investing, so putting in small amounts of money every month, will eventually lead up to a good amount of money which is invested. But most of all, it allows the investor to take advantage of the volatility of financial markets. So you don't put all your money at one particular point, at one particular price, and that allows that kind of price averaging along the way, which is so beneficial for investors. This is an area which is contrary to cryptocurrency, in my opinion, totally overshadowed by many investors.
Yeah. And I think in something like cryptocurrency, what might be a bit of an issue when compared to stocks is fine, it might be the future, but how do you figure out kind of what it's worth today? It's very difficult to value, right?
Is why, in my opinion, speculation is so evident in the market. I mean, I cannot understand how any particular asset at this moment in time, can go up threefold in 3 months. This is what happened to Ethereum in the first quarter of the year, basically, and it's still going on. And mind you, let me repeat myself, I like the underlying technology behind Ethereum. But yet the price of this currency going up this way. And let me remind you that we haven't heard about cryptocurrencies in the last 2 years because the prices of Bitcoin, for example, went down significantly over the year. So what we're seeing at this moment in time is a lot of hype because prices are going up ballistically. And that is, in my opinion, speculation, and it can get risky.
Okay. And back to stocks. What do you think about value versus growth at this point? Do you think there's a reason to choose one over the other, or maybe is a balanced approach more applicable?
Again, Steve, I've had this question for years now, and I've always answered that I really don't find myself in a partisan manner. I don't take a partisan approach when discussing value and growth. For the same reason I explained before, I don't feel many sectors within the value category, or what we think is value category, are very heterogeneous, and same applies for the growth category. So you have different sectors within these two big bubbles, which really and truly are made up of individual companies whose dynamics can change a lot from one company to the other. So rather than looking into value and growth, my suggestion would be look into the individual company or into the individual sector and try to identify which dynamics will move that sector upwards or downwards. Of course, at this moment in time, to answer your question, there seems to be a positive increment in yields, in interest rates. So one should assume, or one would assume, that the value category should start reaping the benefits of this slowly increasing interest rates in Europe and the US. Said that, however, we've seen this incremental yields have started since midsummer last year. Up till end of year, we still saw technology stocks doing very well, which are de facto a growth category or defined as a growth category. So really and truly, you see, this interrelationship between value and growth is often discussed, but in reality, when you dig down into financial markets, you feel there is less of a concentrated or a one way of seeing things in this spectrum.
Yeah, makes sense. And then in terms of maybe some individual stocks, over the last few years, have there been any that you've led to change your mind on? Let's say at the beginning you might have said, yeah, I would never invest in this, but over time they've managed to convince you that it's actually a good proposition?
Well, it happened really the other way around. I liked banks a lot early in this decade, right after in the last decade, quite frankly, right after the financial market crisis and the economic crisis that followed. There seemed to be a lot of value in banks because prices and valuations were extremely low. And I have to say I was quite confident in European banks. But then I had to change my mind, and I changed my mind on this segment because regulation was stiffening. But most of all, because I've noticed that banks, particularly in Europe, are very, very slow into taking up new opportunities, such as fintech, for example. And the fact that the digitalization of financial system is so slow in Europe compared to other jurisdictions such as China and the US, is making sure that European banks, particularly the larger ones, remain pretty much a laggard in today's financial markets. So this is an area which I had to change my mind on in the last few years.
And then on this topic of fintech adoption, what do you think of local stocks like BOV when you compare them to the big banks across Europe? Is there a difference, or are they in the same boat?
Unfortunately, I have to say I feel they are very much in the same category. Although I have to say that Maltese banks are much smaller compared to European peers, to the larger systematically important banks. And this has one big drawback for banks the likes of Bank of Valletta that you've mentioned, but it has some benefits. The main drawback is a one-size-fits-all regulatory regime, which really puts all systematically important banks in Europe pretty much in the same category. So regulation is really having a negative impact on systematically important banks of a smaller size, like, for example, Bank of Valletta, but other banks in Malta, which will become systematically important in the coming months. On the other hand, however, I feel locally we strive a little bit and we struggle a bit in order to adopt new technology. So I think more can be done in this area, and it's very, very important for financial operators in Malta and banks particularly to push forward this agenda, perhaps using and taking up synergies from the local gaming industry. We have a very buzzing ICT industry here in Malta, and there is a lot of potential synergy which can be created, which these banks and these financial institutions in Malta can really tap into and make inroads into the fintech area.
Yeah. Oh, very, very interesting. And what do you think about stock market valuations at the moment? Do you think it might be a situation where you'd rather wait for a correction and then really go in at that point? Or do you think it might make sense to invest regardless?
Look, Steve, it's always very difficult to time the market, and it's a segment which I always try to avoid in reality, particularly short-term market movements. You look at the S&P 500 at this moment in time, and you're looking at an index which is pricing at 25% higher peaks than the peaks we had before the COVID pandemic hit this world. If you look at valuation matrices, I look a lot into price to EBITDA, which is the value of stocks, the price of stocks for every euro or every dollar of operating profits. We're standing at 16 times price to EBITDA, which is extremely high compared to a year after the 2008 financial crisis. At that moment in time, stocks were priced at 8 times EBITDA. Okay, so we're looking at double the valuations here. So we're looking at prices at stocks, which seems to be, with this matrix, twice more expensive compared to what they were 1 year after the last financial crisis. And today's crisis, of course, in real terms, is much, much bigger. And even if we'll take a step even backwards and we look at the price to EBITDA valuation back during the dot-com trouble we had in financial markets like 20 years ago, prices reached the peak at 11 times. So we're really looking at very, very pricey operating income at this moment in time, which is not to say that one should expect a correction anytime soon. Because there are other dynamics at play. Valuations can stay elevated for a longer period of time. I usually look at 3 matrices. Apart from valuation, I like to look at volatility, because usually corrections are anticipated by a period of very, very low volatility. And we're not at that moment in time, we're not close to that kind of low volatility threshold. We're going there, but we're not there yet. We've had a longer period of even lower volatility in previous years. And also correlations between equity markets and very high value bonds. It's not extremely high at this moment in time. It's not low, but it's not extremely high. And that's also another matrix I usually look at before trying to give a judgment on where the markets are going. The fact that yields are slowly increasing, and this has been pretty much the trend for the last 6 months, gives some kind of comfort to financial markets. So if I have to answer your question, well, there are some very strong valuation signals in terms of expensive markets and some important indicators in terms of volatility and correlation, which one has to keep under track, under control in order to try to anticipate possibly or to hedge potential positions.
Okay. So it seems like even though they are expensive, there aren't those classic indicators that might be saying there's a correction coming anytime soon.
Well, look, Steve, financial markets always try to anticipate what's going to happen in 6 months, 1 year down the line. And at this moment in time, financial markets are really and truly pricing a very strong, tangible recovery. Okay, they're pretty much pricing a lot of fast and a lot of positive impact from the recovery post-COVID. In Europe, we're looking at vaccination rates in Europe, which is a very slow, I see a very slow vaccination rate take up, which could pose a significant risks. To the, this is compelled, in my opinion, by high valuations. But again, markets could remain, and this has been the case for the last 6 months, have remained at very elevated prices and at very elevated valuations for a longer period than one would expect.
Yeah. And after COVID, because now we're starting to open up slowly, do you think it's kind of a straight back to normal scenario? Or what kind of risks do you see that maybe not everything is going to go as planned?
Well, post-COVID, which is pretty much today, because when you think about financial markets, when you think about the future, the immediate future, then that is what the market is pricing today. I see an economy, a global economy, which needs to be much more digital and much more digitized. And that will have an impact across different sectors, and it is having we're seeing the impact in stock markets as well. I'm seeing a much higher level of automation, particularly in the industrial sector and in the manufacturing industry as well. I still believe that technology will be the big driver for in a cross-sectorial manner across different industries, in a world where supply chain management, for example, will need to be totally modified in a post-COVID environment. So I see robotics as being a major benefit benefiting most out of this situation, just like artificial intelligence, big data analytics. These are the segments where I would expect financial markets to focus their attention on. They have been doing so for the last years, but I really believe that these trends will not reverse anytime soon. I also believe that the pandemic has had a very positive impact in terms of the consumer behavior, particularly in the environmental and green expectations. And green stocks and green investments. This is an area which has been on the radar for the last years, but it seems that last year in the pandemic, we've had quite a higher element of sensibility and sensitivity emanating from different investors into this spectrum. Last year, we've seen a record-breaking year for green stocks, for example. And this is another driver which I feel is very, very important, and that's why I think we've discussed this before. I like at this moment in time I like carbon pricing a lot and carbon pricing allowances a lot, and this kind of themes.
And outside of the realm of carbon pricing, so you're seeing a lot of customers more willing to do business with green companies rather than the less green companies.
Yes, particularly in mainland Europe, but also in the US. With the change in administration, the impetus that has been given to the Green Deal and to moving the economy towards a greener and more sustainable economy in the US will have ripple effects, positive ripple effects along the entire supply chain, and therefore all the stocks across the globe. And even in China, we're seeing the same kind of attitude in Chinese markets as well. So I think that's something which is very beneficial. And if I have to say, if this is the silver lining, this could be pretty much the silver lining of the pandemic. Yes, this is an area which I really like, and it could be a theme which really drives profits into the future.
Okay. And lastly, maybe on a bit more of a general note, what do you think retail investors and professional investors are doing wrong at this point? What mistakes are you seeing, given your historical knowledge of what's actually happened in the market, and maybe what are they doing correctly?
Well, I think something which has always been problematic is the demarcation line between speculation and investment. And I see a lot of hype into specific areas, people thinking that they are investing, and it is not just retail market, and it is also institutional investors. I've seen this with institutional investors as well. And I feel there is a lot of speculation going on, which is being masked as investment. And that could be very, very risky, particularly for those investors who cannot tolerate an elevated level of risk. And the fact that yields in the fixed income market, the bond market, have remained so low for such a period of time, such a long period of time, I think could also have a very detrimental impact on that segment of investors, particularly retail, but also institutional investors, which are chasing higher yields, irrespective of the fact, or perhaps carelessly enough, because they might not be considering the fact that the risks that they are onboarding by chasing these kind of returns is much higher than what they can actually tolerate. That is an area which I feel many investors, that's a particular risk which I feel many investors are overlooking at this moment in time. I wouldn't say it's just something which is happening right now. It's something which has happened quite often in recent years. But the fact that we've had so much fiscal stimulus and also a lot of monetary stimulus, perhaps it has it will have a higher, we're pushing boundaries in terms of the speculation level that many investors are taking on board.
Yeah. Okay. And do you think this is something that normally ends badly, or could it just continue for the foreseeable future?
Well, usually it doesn't badly. I keep on saying to investors that there's nothing wrong in enjoying a bubble, enjoying the party, so long as you can leave the party when champagne is still flowing. And often, quite too often, people don't understand the fact that you do not control markets. A bubble can burst anytime. And you have to ensure that your margin of safety is covered and your risk tolerance is covered all the time. And it's not easy to convince people of this argument when markets are doing fantastically, like they've been doing for the last year after the pandemic, despite the fact that we're going through, as a globe, as an entire planet, we're going through globally the worst financial crisis we've ever experienced.
Yeah. Okay, makes a lot of sense. Having said that, that's the last question I have for you at the moment, Steve. Thanks all of you guys for listening in. If there are any questions, let me know. I can forward them to Steve and we'll see what opinions he has on those. Thank you very much.